The unicorn setup consists of two main concepts, the breaker block and the fair value gap. Now, for those who might not fully understand what they are, let's go over each one step by step. A breaker block consists of a low, a lower low, and then a higher high for a bullish breaker. And for a bearish breaker, it's the opposite, a high, a higher high, and then a lower low. The candle that forms at these two swing points is what we refer to as our breaker block. Now that you understand what a breaker block is, let's move on to the fair value gap. This gap, the space between the first candle and the third candle, is what's known as a fair value gap. They can appear in different variations, but as long as there's a clear gap between the first and third candle, that area is considered a fair value gap. Now let's talk about how both concepts come together to form what we call the unicorn setup. This setup is simply the combination of the breaker block and the fair value gap. When the two overlap each other, they create an area of high value. In this example, you can see a low, a lower low, and a higher high, which makes this candle our breaker block. Now the unicorn model forms when price creates a fair value gap inside that breaker block. That now makes that area a high value zone, because when those two powerful concepts overlap, there's a very high probability that when price returns to that area, it will most likely hold and push price to the upside in this example. Now that doesn't mean you should go to the chart and start trading every single unicorn setup you see. For it to be a high probability unicorn model, it must also have a higher time frame narrative backing it up. So for instance, if this setup forms inside a higher time frame point of interest, and then you see a unicorn model forming on a lower time frame, that combination gives you a very high probability that the trade will most likely play out successfully. Now let's look at some examples. Here we can see price pushing down. Then it created a low, a lower low, and then a higher high, which makes this candle our breaker block. Now, after mapping out the breaker block, we can also see that there's a fair value gap perfectly in line with the breaker block, which gives us our unicorn model. Stop loss should be placed below the breaker block and take profit at the previous high or at the 1-to-2 risk to reward ratio. And here you can see how price tapped into that region and eventually pushed to our take profit. Now, let's look at another bullish example. Here we have a low, a lower low, and then a higher high. So we map out our breaker block, and we can also see that there's a fair value gap overlapping with our breaker block. Knowing this, we can place our stop loss below the breaker block and target either the 1-to-2 risk to reward ratio or an opposing liquidity level. And as you can see, take profit got hit. Let's look at a bearish unicorn model. Here we have a high, a higher high, and then a lower low. That left us with a fair value gap and also a breaker block. Entry will be at the breaker block with stop loss just above it and take profit set at the 1-to-2 risk to reward ratio. You can also see how price tapped into our entry and immediately pushed to the downside, hitting our take profit. Now, something you should keep in mind is that these examples were handpicked to show you how it works. But that doesn't mean it works like this 100% of the time. So it's best for you to align it with a higher time frame PD array to give your trades a higher probability of playing out, even when you align it with a higher time frame point of interest. That still doesn't mean you'll win 100% of the time. Always keep this at the back of your mind. If you found this video helpful, give it a thumbs up and subscribe below. See you in the next one.